So credit, that's the first thing that we highlighted. Of course, character is not so much a role anymore unless you're applying for an SBA loan, but cash is king when it comes to down payment. The capacity to be able to pay back that loan, which is also important. And of course, collateral, cross-collateralization, or in this case, the home itself. But these two right here are the top dogs when it comes to, everyone knows that. Does that make sense? Okay. So this is the key factors. Now, if you, on the little handout you have on your chair, at the top it'll say, I have highlighted credit here. Pull it out and turn to the second page. And we're going to go through this here momentarily, but this is what they call the key factors that affect your credit score. The first one is the 10%. Let's take a look at the third item on this page, which is talk about timely payments. And the third item talks about timely payments on your credit and creditors. From experience, when you have a late on a mortgage, it could drop just a 30-day late. It could drop your credit score between 10 and 30 points as each one occurs, according to Fair Isaac. You're going to hear me say that a lot today, according to Fair Isaac, according to Fair Isaac. So just one 30-day late on a mortgage can reduce your credit score between 10 and 30 points as each one occurs. Now, let alone a 60, a 90, 120, 180, where it goes into charge-off status, that does even more damage. If someone has constant lates on their credit cards, not so much on the mortgage, but automobile loans, credit cards, and student loans, they get paid here, but the due date's here, late fee, and they constantly have lower lates on their credit report. What can they do to help themselves immediately before we start credit repair to not have any more lates? What can you do to stop having any short-term, long-term lates? The answer is move your due dates. People don't know that actually you can move your due dates on your credit cards, your automobile loans, even student loans, to have any short-term lates which would really damage your credit. Now, a mortgage due date, they like to be paid on the first of the month with a 2-week grace period, so you have to stick with that one. But credit cards, you can move them as often as you want, and they'll be pretty flexible to do so. A lot of people don't know that actually you can move your due dates on your credit cards, automobile loans, etc. Because lates is a huge factor. Even on a credit card 30-day late, you're looking at somewhere between a 5 to a 15-point loss average for each late that occurs. Okay. The last item on this page, I'm going to kind of jump around a little bit, is outstanding debt. Now, you can see up on this profile, according to myfico.com, the third one we just talked about makes up a third of a higher or lower credit score, 35%. The last one is another third, 30%. Between these two, 65% or 2/3 of your high FICO score is dependent upon you paying your bills on time and keeping debt low. Outstanding debt. Carrying high credit card balances, or even better yet, closing certain accounts, may ultimately hurt your FICO score. Not maybe, it will. Because, for example, in this example, total available credit. See, the human element, when you do an application for a mortgage or a credit card or a business loan and whatnot, they look at the DTI factor called debt to income. So if your income's here and your debt's way down here, that's good. But if debt starts creeping up by charging on the credit cards, or go out and buy yourself a high-end Ferrari, you go, uh-oh, you're paying $1,000 a month on your car payment. They run your credit day before escrow closes, and they say, oh, your debt went up during the 45, 60-day escrow period. And they say, no, you can no longer afford that mortgage payment. So when you're about to refi, or better, buy your house or rent a property for the first time, keep debt low as possible. Don't buy anything new unless you have to. Make sense? The Fair Isaac scoring factor does not care about your actual dollar debt. They look at what they call the total percentage of availability. So in this example, if you see like on card number 1, it says, let's say you have a $500 balance with a $1,000 credit limit, you have a 50% availability. In credit card number 2, and again, I'm only talking about revolving, I'm not talking about student loans or car loans. Anything that revolves, like Macy's, Sears, Visa, MasterCard type of cards. Credit card number 2, you have a $2,000 balance with a $3,000 limit, you have a third availability. And same thing with number 3, 2,000, 5,000, 60%. They evaluated they have a 50% availability. On a credit report, one thing I'd like to grab over here is that when you run a tri-merge report, it takes a look on the profile summary, what they call the total percentage of availability. So on the first page of a client's credit report, it's going to say right there in plain English, this lady's got a 42% availability. Not good. The higher that availability is, the better off you are. According to Fair Isaac, if you have only a $2,000 credit limit, let's say you have one credit card, for example, you have a $2,000 limit, and you're maxed out at $2,000, nothing available. Nothing past due, not a dollar. You're right at $2,000 on time. You make that minimum payment for 6 or more months on that credit card debt. How many points do you think you lose according to Fair Isaac? About 100. 100 FICO points, just being a 2,000 limit with 2,000 of the debt. Really, the average loss, if you look at myfico.com, is between a 50 to 150 point loss, but let's say it averages about a 100 point loss. Imagine paying it down to 0, gaining back those 100 points. That can make or break a really good real estate deal for you. Imagine going from 605 to 705 FICO. That can be huge. So as we go into this, during the whole process, what they call a potential effect of closing an account. If you take a look at item number 4 on this page, what does it say? On the form it says length of credit history, which is only about 15% of the factor. Never ever close old accounts. Has anyone in the room actually closed a credit card or two and you've seen your score go like this? Do you really know reason why? Well, the credit report won't tell you because of the fact of length of credit history, because the credit reports do calculate how old the account is. So for example, if that credit card that you closed, let's say it was from 20 years ago, your second oldest account was from 10 years ago, so there's a 10-year gap. This one goes away, you lose that 10-year history. So when it says that by closing certain accounts, and also another thing that's detrimental in today's market is that the credit card companies are reducing people's credit limits. See, back on this previous slide, let's say in this example, you know, you add up all your debt, add up all your limits, and it says you have a 15 total % of availability, you divide into each other. Well, if this account, for example, let's say this large one here were to close and you lose that 3,000 height, that means you're going, let's say, for example, you have $5,000 in debt and 10,000 limit, your limits go down to $7,000. This availability shrinks. You lose FICO points. How many? 20 to 50 points, who knows? So it's imperative to keep limits as high as possible, debt as low as possible, and old accounts open. Did you ever notice on your own credit report that certain major credit cards like Visa, MasterCard, Discover, Amex go inactive and then close? Does anyone know why they go inactive and close? Have you seen it happen first up? They go inactive because it costs that creditor, be they Wells Fargo, Visa, MasterCard, Discover, Amex, money to pay the credit bureaus to keep that account open. And that cost, according to Fair Isaac, is about $1 a year or $3 a year because there's 3 credit bureaus. So if you have that old Bank of America account from 20 years ago, Visa, let's say with a 10,000 limit with no debt on it, but you haven't used it in 2, 3, or 4 years. So why would BofA pay that $3 a year, $1 to each credit bureau times 47 million customers? See, I can add up. So they can save millions of dollars in a bad economy by closing those accounts. And guys, they are closing them quickly now. After 2 years of non-usage, they're closing. It used to be 3 or 4 years. So you got to use the account at least 1 or 2 times a year. It's a $1 charge, annual fee being charged. I don't care. Just keep it alive. Use it once or twice, and force them to spend that $3, and the account will remain open the rest of your life. Department store accounts, on the other hand, are cheap to maintain. I've seen people have Mervyn's and Nordstroms and Sears on their credit report. They haven't used the account since 2000, 1995, and the account's still open because they only pay about 15 cents to 25 cents a year average to the credit bureaus. So they're hoping that Christmas is going to roll around in a few months. You're going to charge a whole gobs amount for clothes or whatever, electronic goods, and charge you 35% interest rate. So, but it doesn't matter though if it's a minor account like a department store account or a major credit card like Visa, MasterCard, never close them. Now, if an account like a major credit card closes on its own due to inactivity, that doesn't get rescored into your profile when it comes to this kind of stuff right here.